Our first guest says that amid the global turmoil, markets are seeing huge levels of trading volume. We're off to the TSX for more on this from Barometer Capital's Diana Avigdor. Diana, good to see you again.
Good to see you too.
So it looked like yesterday at the worst level of the day, we were down 500 points. We rallied well off that. Today we've regained all that lost ground. What does that tell you?
Did the market close up? Is it up? Because you never know. Every 10 minutes it's something else. Volatility is very big. And yes, yesterday was, I heard from trading desk, it was the highest non-expiration volume since for a few years now. I think it was 2011. So why? And today too, the volumes are up about 25 to 30%. You know, this market has been extremely volatile. Not that it wasn't expected. However, we didn't expect to be down this much, this quickly. There's two pressure points that I want to highlight. One is the correlation of the U.S. S&P with Chinese market, and the other pressure point is the U.S. S&P with energy prices. So I'll start with oil because it's close and dear to our hearts in Canada. It's almost 100% correlation between the S&P and oil prices, and yet the weight in the S&P is less than 10%. So why is that? People are worried, not so much in terms of what it means from a macroeconomics perspective, what it means to growth and all the other metrics that we talk about over the long term, but people are worried about the stress point in terms of somebody's in trouble, prices are so low, there's some stress going on that is structural in terms of leverage and interconnectability of asset classes and what might be going on. A lot of risk is coming off. So when yesterday, one of the things that happened at 2:30, the oil January option market has settled, the pressure sort of came off. So it felt to me, by putting on my trading cap on, that it was a little bit of exacerbation in terms of pressure. And when it came off, the market was able to rally together with oil that came off from down 5% to only down 2%. I think it was down yesterday.
Mm-hmm. I know that you've been taking a closer look lately at Starbucks. The company's quarterly results have just hit the tape. Let's take a look at the numbers. I want to get your first blush response to that. Quarterly results coming in a penny better than the street expected. We're looking here at 46 cents per share. Originally 45 cents was what we were looking at this time around, whereas the revenue line comes in pretty much as expected at about $5.4 billion, 5.38 or so, I think was what the street consensus was looking for. But Diana, when we look at global same-store sales up 8%, what does that tell you about the health of the global economy on a company that has its fingers in pies all around the world?
The whole, you've seen last year a divergence of stocks and companies that haves and have not. Starbucks is one of those companies. I think we continue to trade that way in 2016. The 8% comp, I think it was expected 8 to 9%, and I'm happy to see EPS and revenue about in line. We're going to want to hear on the call about mobile pay, and we wanted to hear about the call about the pre-order system that they've put in place, where you can pre-order your coffee and then go and pick it up. So there are some metrics that are driving that growth. Revenue growth is about 12.3%. Overall, first blush, it looks okay, but we'll wait for the call. We like it. We own the stock, and we were waiting for these numbers. Starbucks is one of those companies that's gaining market share, and it's up on the technology front, making it easy for people to continue and to order. It does have some FX headwinds. We want to see how they fared in that perspective.
Now, to your point about owning it already, if you had a client who wasn't already in Starbucks, street consensus is 68.35 over the next 12 months, suggesting about 15% total return, including that dividend. Is it a buy today, or do you want to see some weakness and buy in at a lower price?
I wouldn't sell it, but I'd want to hear the call. The market is sloppy, and I'd like to see how the stock reacts. If I was pushed into a corner, I would. If it was just a yes or no, I would say yes.
What about the valuation at 31 times forward earnings for a company that grows as broadly as Starbucks does? Is that a reasonable multiple?
You know, the multiple matters only when earnings do not meet expectations. In this case, I think that if earnings continue to grow, and if they have the catalysts that we're seeing and they're working out, I think that the multiple it's a matter of a moving target. If earnings start growing there is an upside to the growth rate of the earnings, and so the multiple becomes a little bit irrelevant. Not that it's irrelevant, but cheap stocks tend to be cheap for a reason.
And again, to your point, when the conference call hits, among other things, you want to find out what the impact is of the strong U.S. dollar against the company's cost line?
Yeah, and how they're faring on the growth catalysts, like I said, the mobile pay system and the pre-order.
Diana, always great getting your insight. Thank you for your time.
Thank you.
Diana Avigdor is a portfolio manager and the head of trading at Barometer Capital. Again, quarterly results coming in here a penny better than expected at 46 cents per share. Meets on the top line at $5.4 billion as the company reports global same-store sales up by 8%.